Good evening, everyone. Time for another silver update. This is the Dow daily chart provided by netania.com. You can click on the link below. I've got a couple of trend lines I've drawn here. The lower trend line, excluding some action there. Upper trend line, of course, with a number of touch points here. So pretty firm trend channel. You can see we got a bounce off the bottom of it, and this is a rally that we were waiting for, trying to determine if the move in gold and silver especially was going to be a deflation protection play or a potential QE3 or money printing play. Now we've got a confirmation with a big move in the stock market, very large move, 280 something points. We also have a very decent move in the oil. Appears to be kind of a bottom spike, about $4 off the bottom. And then of course the big story of the day is silver, that was up almost 5% at one point. You can see it pretty much touched $30 and was very close to getting through there. It had a very classic, we'll pull in here, classic saucer type formation. You can see that it broke out of normally these types of very steep runs that are then followed by a very minor decline and then subsequent rally up to the other side. Those usually are fairly strong moves, and that's exactly what we got. We've had a little bit of pullback here from that $30 or so level. Nevertheless, that's a big move from the bottom of around 27.20 all the way up to 29.90 or so. Big move, and I think that it's probably a confirmation that there's going to be some money printing pretty quick here. Gold was not quite as strong as silver. You can see, although gold pulled back a bit here, it had a bigger move, and it was one of those very striking moves that doesn't really pull back. You can see that here. Normally those are very bullish moves. Now in a sideways market they don't necessarily have to be the case, but if it is a bull market, then usually those aren't given back. Back to the stock market, you can see that when you have a period of volatility, we'll go to the daily here. You can see if we zoom in on this area right here, around August through late October, so last year, you were getting big moves. You can see the bottom of this range here is around 10,600, and the top of this range is somewhere around, we'll just say 11,600. So you've got this 1,000-point range, and this is the daily chart. So you can see with daily moves here, you can see here, that's a 500-point move. There's a 500-point move. There's 300, 300, 200, 300. So it's quite possible to get this type of volatility. We could be going into something like that. You can see this volatility here is still nothing close to this volatility. And if we go back far enough, the volatility that we had back with the financial crisis, actually we're not far enough back yet. If we go back to this volatility at the financial crisis, you can see that there was tremendous volatility. So we have had that volatility in the past. We may be going into that area now, or we may actually just be turning up. The MACD, you can see, is starting to round up, so it may be that turning point where all the markets start to rally. So let's go to the question of the night, and that's from Silver Taku, and he asks, "Hi Brother John, many thanks for all your hard work. I, like you and many people, see a huge mess in finance all over the world. Politicians have their own agendas. with the party line which stops any fixes dead. To even start to fix this mess, some very strong measures must be taken. Is there any reason why both parties, i.e. Republican, Democrats, suspend fighting for one of their own causes and make a fix? This is an emergency which every party that does try to fix will get the backlash for cuts, etc., which must be made. The emergency coalition where votes and decisions will be made jointly will be easier to make because the blame will be shared, not blamed on either party. This could be for a set time until the country is fixed or on the right track. Well, I suppose that's possible. In my opinion, it's highly unlikely. And one of the main reasons is that the politicians have basically stolen and wasted all the money. So, Social Security, for example, which was supposed to be a lockbox or a trust fund, they borrowed the money and put treasuries in there. So that money's gone. They've already spent it. They mixed it in the general fund. And the problem is that, and the same holds true with the bankers. Anytime you try to talk about austerity, and rightly so, not saying that austerity isn't a good idea. It is, especially when we're talking about austerity for government workers. But anytime you start to talk about austerity, you immediately get the other side saying, what about the bankers? And that's a very legitimate criticism. So, unfortunately, because the bankers were given trillions of dollars to waste and for their bailouts, and then on top of that, the behavior of these bankers was so egregious in that they, instead of being made into kind of civil servants where when you nationalize something, then basically they should be workers for the government paid, reasonable, modest wages. But instead, they bailed out the bankers, and these brazen bankers paid themselves enormous outsized bonuses out of taxpayer money. So because of that corruption, and because of the fact that the politicians have already stolen and spent all the money on their constituents to win re-elections, because of those two factors, there's just no way that you're going to be able to make the argument for austerity. So anytime that any politicians come in and try to force austerity, they rightly are going to be asked, what about all the money that you gave to the bankers? So I just don't see a situation coming out of it where they're going to face the music. It seems to me that their easiest way out, which seems to be the one they've always taken, is to just print their way out. They have a lot of debts they need to pay back, and they have the power to print up the money to pay them back, and they will risk hyperinflation. They'll probably try to sterilize the money somehow, probably get away from them. But that's my prediction for the course that they're going to take. I don't think there's going to be a bipartisan effort to try to actually tackle or fix these issues. So I wanted to head back to the Silver Bomb again and read some more on this fantastic book, and I'll again cover where you can order it. But let's jump back into the Silver Bomb. This is from page 133. I'm just going to read a little bit of this. This is going into the fundamentals of silver. At the same time that industrial use of silver is mushrooming, demand for silver as an investment commodity has blossomed to never-before-seen levels in the developing nations. Most notably, Chinese and Indian investors have taken to buying both gold and its cheaper running mate silver as a store of their newfound wealth. Investor demand is increasing along with industrial demand. This double demand has created a great part of the unique set of conditions that are now beginning to become apparent. The supply of above-ground silver, sought after for all these uses, particularly in the last few decades since the advent of electronics, has been seriously diminished. The all-time greatest discoveries of silver have all but been consumed, returning the world supply to scarcity levels not seen for over 700 years. Demand for silver is high and the supply is low. That is usually the recipe for skyrocketing prices of any commodity. Usually it only takes motion in either the supply or the demand of a commodity for it to reflect in market pressure triggered adjustments to price. Usually if demand goes up but supply remains constant, prices react to upward pressure and go up. Likewise, if demand is constant but supply diminishes, prices also usually rise. Both of these changes reflect more demand than can be met with existing supply, and both are normally reflected in higher prices. If demand goes up at the same time that supplies diminish, the demand outstripping supply upward pressure effect is exponentially amplified and the price goes astronomically high. Strangely, this has not been the case with silver. Not yet. Silver exists in the Earth's crust at about 16 times the amount of gold. That means that historically there is about 16 times the amount of silver being mined as there is gold. That has always priced silver at about 1/16 the price of gold. There have been exceptions to the 16-to-1 rule, notably when the silver supply in the United States swelled with the discovery and development of anomalously rich silver finds, such as the legendary Comstock Lode. These finds of the late 19th century caused the issuance of millions of 1-ounce U.S. silver dollars, which were for decades the prominent form of common currency. The amount of silver flowing into the economy was a great factor powering the burgeoning national expansion of the United States of America. Much of the wave of industrial mechanization of farming was financed with silver, as the silver farmers, as they were known, were able to bypass the central banks as they could receive low-cost silver money instead. The effects of these forces began a running battle between the central banks, who sought to control the price of silver, and the free market forces, which would adjust its price naturally according to true supply and demand. The manipulation of the silver market has been behind the scenes throughout the history of central banking in the United States, including recently surfacing events of banker collusion to manipulate silver. While market manipulation has been going on since there were markets, this practice has now gotten so out of hand that the news of it has leaked out into public view. It began as part of the fallout from the 2008 debt crisis. Several banks took advantage of a competitor's illiquidity and absorbed them lock, stock, and barrel, such as in March 2008 when J.P. Morgan Chase acquired the fatally ill investment firm Bear Stearns. Part of what came in the purchase were a massive number of Bear Stearns' existing short positions on silver futures contracts. A short position is essentially a bet that the price of a commodity will fall. Stearns' position would be worth billions of dollars if the price of silver fell. It would have been a tidy sum for J.P. Morgan to have had bought ownership of. There was but one fly in this multi-billion-dollar ointment, and that was the rush of investors into silver positions as a safe haven for their hard-hit dollar-denominated portfolios. Were this to have had the normal effect, it would steadily drive the price of silver up. On March 16, 2008, the very day that Bear Stearns went out of business, silver had risen to a level not seen since the 1980s and hit the price of $21 per ounce. This would have been devastating to J.P. Morgan Chase, who was sitting on piles of bets that the price would go down, not up. Then the unthinkable, according to the laws of economics, happened. Inexplicably, from March 16, 2008 forward, when there was directly in J.P. Morgan Chase's favor, the price of silver fell nearly 17% lower. While the average investor scratched their head in disbelief and tried to fathom how this decline in the price of silver could happen, J.P. Morgan Chase was not only saved from catastrophic losses, but allegedly took on even more short positions and heavily increased their stake. Silver began to rebound and by July 14th had righted itself to $19.30 per ounce. It again looked like J.P. Morgan was going to get clipped, as they then held, along with HSBC Bank, at some estimates over 85% of the commercial net short positions in silver futures contracts on the COMEX. This would have allegedly caused them to have been in arrears for an eye-popping 169 million ounces of silver, virtually equal to the entire COMEX warehouse stockpile, the second largest in the world. That much silver would have been roughly 20% of the entire world's annual mine production. There seemed to be no way out for JP Morgan. Again, for no discernible reason, the price of silver began to sink and sink and sink even more until it had lost over a third of its value in just 30 days, when by August 15th it stood at $12.82 per ounce. Then the bottom totally fell out, and by October, silver was left grasping at a measly $9 an ounce. Many investors were destroyed, and for a moment silver was so low that it essentially could not be gotten rid of. So we're going to stop there. Excellent history. A lot of the stuff we've covered before, but it's all put together in one place. So I highly recommend the Silver Bomb. Again, you can get that book if you go to my blog site, and over here on the right is a link to the Silver Bomb. It'll take you to the ebook, and you can purchase the ebook online. So I just wanted to wrap it up and give my condolences to the family of Bob Chapman, who has recently passed away. Rest in peace, Bob. He was a stalwart fighting against the New World Order and the Illuminati bankers who are constantly trying to enslave mankind. They're still at it. They never give up with their IMF and anything they can do to enslave people, countries, nations, blocks of countries in usurious interest rates, which destroy them and then have them take over the real assets of the nations and sell them off to their oligarch friends. So Bob consistently fought against these people and exposed them, and he will be greatly missed. Our thoughts and prayers go out to his wife of 47 years, Judy, and his son Robert Michael Chapman, daughter Jennifer Giladi, and her husband Matt, sisters Dorothy Trecker and Joan Lotz. So, wonderful man, and he will be greatly missed. So, again, the silver story today is that we had a big rally off this bottom, and I was looking for this period of time that's going to match the rally period that we had from the beginning of QE2. We may be hinting at something like that now. We're looking for the MACD to cross up over the zero line and this thing to get real legs, and we'll see how high we can go. And we'll talk to you next time.